The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. And if you want to reach out to me, 631-647-4694. Or you can always check me on the web, themainstreetcode.com. Or if you miss an episode, I have YouTube videos on my website, as well as Spotify and Apple. You can, if you're driving in your car and you want to hear an episode, just check those out and you can hear past episodes. So what do we do here? Well, our code is choice, organization, direction, and education, and we work with hundreds of advisors across the United States, including attorneys, CPAs, and other financial professionals, to help you with your insurance needs, whether it be life insurance, long-term care, disability, and annuities. And those are my areas of specialty. And I speak all over the country. I speak locally, 2 attorneys, 2 accountants. Next week, I'm going to invite any financial advisors that are interested, whether they're in the insurance business or whether they're accountants, whether they're attorneys, property and casualty brokers, anybody in the financial world. I'm doing a seminar February 14th. Yes, I know it's Valentine's Day. It's 8:30 in the morning at the Sheraton 4 Points. If you would like to come, and of course it includes breakfast, you need to call me at 631-647-4694 and register. If you just show up, it'll be $25. So if you're interested, reach out to me, and I'd love to have you there. The seminar and discussion is going to be something we talked about in the air a few weeks ago called, Does Your Business Have a Will? Now, we talked about this. If you're self-employed or you have a partner and you have a small business or a big business, having a will and a succession plan is very important. So what I've done, like I do with my group, is I have a forensic CPA who's going to talk about the importance of knowing the value of your business and updating it. There's also been some legal legislation that has come about that's important. We're also going to have an insurance company talk about the different insurance structures for insuring that will, so that you don't have to go to work with your partner's spouse, or, you can have coverage so that if, one of your children wants to stay in the business, but one doesn't, and this way they can pay out a claim, pay out something so that your business can still survive. There's many different reasons to having a proper insurance structure or having a will for your business. And just as an aside, I want to get into some other areas today. One of the things I notice about your business having a will that's so important is when we do insurance applications and everything else, people don't realize their net worth. They'll give you a whole net worth thing, but they leave out their business for some reason. And maybe the questions aren't asked on applications and this and that, but some of the biggest values you have as an asset is your business. That's where your income comes from. So if that's your biggest value, monetarily and everything else, why wouldn't you protect it? And why wouldn't you protect your income? And how do you protect your income? There's something called disability insurance. So if I become disabled, how's my business going to run? Or how am I going to run my business? How am I going to feed that thing that I need, which is, listen, we all need money to support ourselves, to pay bills, to pay light bill, to pay, this one, that one, the electric, the cable bill. I mean, that's what it is. It's that income. If that income stops, what would cause that income to stop? Well, if you passed away, of course. So how's your family going to live? But also, what if you became disabled and you can't work? What if your partner became disabled? Maybe he fell off a ski slope. Maybe he hit some rare disease. What if he passes away and they can't work? Their family still needs money and everything else. So the way that we do is we assess that risk and we buy insurance coverage to assess that risk so that in case something happens to someone, the business can continue on, or we can get the value out of the business and buy us time to sell it even. They even have disability insurance. A lot of businesses don't even know this. They don't talk about it, because no one's approached them about it. It's called overhead expense disability. So let's say you're a sole proprietor and you run a business and, your plan, you become disabled, let's say, and you want to sell your goal is, well, maybe I got to sell my business. Well, the worst time to sell a business is when you absolutely have to. So you'll never get the best value when you have to sell it. But, the biggest thing is keep the doors open. So they have specific disability insurance that if the business owner becomes disabled, it will cover salary for all the employees, it will cover the lights, it will cover the electricity, maybe only for 2 years. But what does that 2 years give you? It buys you time in that 2 years to sell your business if that's the ultimate goal. If you're not going to be able to go back to work, but you still have this asset, what a great way of protecting your asset, no matter what your income level is or what you're showing in taxes, which is on your personal disability, but you want to protect your business that keeps you guys afloat. That's a huge piece that, it's often not talked about. Disability buy-sell between partners. What if my partner becomes disabled? Yeah, what if he dies? That's a big question because, again, do I have to work with their kids? Do I have to work with their spouse? They're all of a sudden owner, and maybe their kids, oh yeah, I want to work with you in the business, and you're like, well, what do you know about my business? I mean, you're not trained, you're not licensed, you're not. These are the considerations you have to have, and you have to think about it. I was at a business the other day, and we had a conversation, and he's concerned. His business partner is 10 years younger, but his business partner is going through a major divorce. Now, she's going for blood, and he's worried. They have no plan in place, and I don't have a plan in place. What if she goes after my business? Well, that could happen. I mean, that's why we plan these things. So February 14th, 8:30, Sheraton 4 Points. That's in Plainview. If you're interested in coming to breakfast and hearing a cross-section of financial professionals talk about all the implications, call me at 631-647-4694. Email me, go on my website, and we'll get you registered. Otherwise, there's a fee to come. It is filling up. We probably have about 25 people have registered so far. Most of them are part of my networking group that I established, and that's what we do. So, let's talk about things about life insurance. Now, we talk about the virtues of cash value life insurance, but there's many different kinds. And I have a 30-year perspective on what these contracts look like. In other words, I've seen them from the inception to where they are now, and I have a lot of revelations about them that I want to share with you. And if you're looking to buy a permanent insurance plan, you have to know all the options. And I think a lot of times when you see a life insurance salesperson, maybe they're an agent for a particular type of company, And maybe that company only is going to show you what their flagship product is, and you don't get that overall perspective. I like working with brokers who have a good idea, because not every product is right for everybody. Everybody has different goals, needs, and aspirations. Therefore, there's a lot of different types of products, a lot of different type of companies, a lot of different reasons why you might want to buy one cash value product versus another, including why you might want to buy one term product versus another term product. So these are the things that we go over, and fortunately, unfortunately, I'm like the cleanup guy who looks at the policies 30 years later. So when we get back from the break, I'm going to give you a perspective of what I know and what you should know before making a buying decision, or even if you have these contracts, why they should be reviewed. You're listening to the Main Street Code for Financial Success. This is Neil Himmelstein. We're going to be right back after a commercial break. Thank you. Welcome back to the Main Street Code for Financial Success. This is your host, Neil Himmelstein. And today we talked about a meeting we're having on February 14th. It's a breakfast meeting at 8:30 at the Sheraton Four Points in Melville. In Plainview. If you're interested in attending, you have to give me a call and register. 631-647-4694. That whole group is an organization I started with an estate planning attorney called the LIFPN, and we have multiple professionals that are going to talk about, does your business have a will? And I'll be talking about that and talking about situations. Now, before the break, we were talking about different types of permanent insurance. I've been in this industry a long time, and I get to see policies, and I've been working on one this week that it's kind of battered up, and we're going to have some major discussions with people, and I may be saving people several $1 million with what I'm doing with them right now, just because these policies are intricate. They're not, everything's vanilla and great when you buy it, and years later, it's not exactly what you thought you had, or maybe nobody's looked at it, and then all of a sudden everything's haywire, and then you're trying to fix it, and you could be throwing money down the drain, or not doing things right, or get a big tax. I mean, there's all kinds of implications that can happen if you don't monitor your policies. And what I tell people is you really want to monitor things annually. And what I can tell you, attorneys don't know, accountants don't know. They don't know the intricacies of a life insurance policy. They know the basics, okay, which you should know, and which probably someone has taught you if you've purchased life insurance before. But they can't look at a contract like I look at a contract, and I dissect it like an operation, because it really is. There's a lot of moving parts. So the granddaddy of all life insurance, probably the first insurance ever to come out, something called whole life. Now, whole life is designed to have coverage for your whole life. That's why they call it whole life. So it's really the granddaddy of life insurance. Still, I'd say of all insurance sold, and I don't have the studies in front of me, it's probably about 25 to 30% of all insurance sold still today is whole life. Whole life is permanent insurance. That means I have it for my whole life. Why do I buy whole life? Well, a lot of people buy it for cash value. There's no taxation when you're putting money into a life policy. You use after-tax money generally. It grows without any taxation. You can borrow from it at any time once you've accumulated money with no taxation, no 1099s, no credit checks or anything else. It's your money. And essentially you can be your own bank. And that's what many business people do with whole life insurance. And not only that, the death benefit is a legacy for your family, tax-free. You could take out money tax-free. You have a tax-free death benefit. There are no 1099s. And it's somewhat credit shelter proof. So, wow. I mean, if you want to insulate your money so that the government or doesn't get their hands on it, or if you potentially get sued, we've worked with people who have that do obstetrics or do gynecology work, and there's a high degree of people suing them. And yes, they have medical insurance, but people are afraid of them going after them personally. But if their money is tied up in a whole life insurance policy, they don't have that issue. So a lot of people accumulate a lot of money in whole life. Even children or grandchildren plans, starting them young and buying some insurance, not only for the legacy, but for that cash growth that they could use for college or retirement or when they get married, and securing that insurability at an early age. Whole life is wonderful. Okay? So whole life is one great option that I love. Now, there's two types of whole life. One, the traditional type, which pays dividends. Now, dividends are typically offered by mutual companies. There are some stock companies that still have dividend paying, but by the very nature of a dividend, you're a share owner of the company that you buy it from. So it's a participating dividend. Now, they'll tell you with every contract, dividends are not guaranteed, and they're not. So you need to look at the history of how they pay dividends, but consistently, some of the better companies have paid 5 to 6% dividends for as long as I've known them, going back all the way to the 1800s. So very consistent, very solid, very great performer. Little more expensive if you're looking at an expense, possibly, and you can pay it over 10 payments for your lifetime, up to age 65. There's all kinds of ways we can structure a whole life policy. They also have a function of loans. Now, being able to loan the money at what rate is very important to know, because some of them may have a variable rate or a fixed rate, or you can switch back and forth. Now, what happens is, over time, you may take out, I'm working on a case now where a gentleman put a lot of money into a whole life policy, and then later he used it for business. He took out over $1 million of the cash he built up. Now, this is the unique thing, that when you take money out of these policies, the dividends still grow in that pot of money that you've earned. Even if you take a loan on it, your dividends are still paying on that pot of money that you've built up. Now, hopefully, what are the costs coming? So you take out a loan, and maybe you don't have to pay it back right away either. But here's what happens in a whole life contract that people don't understand. There's two things that come out of that whole life policy every year if you've taken out a loan. One is you always have the cost of insurance. Secondly, if you have a loan, they start charging you interest on that loan. Now, what happens is, let's say I don't pay that loan for a year, for 2 years, for 5 years. Everything's going good, but they draw more and more money as I get older for my cost of insurance, okay? The cost of insurance. And they're charging compounding interest on that loan. So if you've taken out too much money over time, or that loan, whatever that loan is, if you happen to pass away, comes off of your initial death benefit. But if all of a sudden you're feeding that by the cash value you've built up in the policy, and that cash value starts to deplete over time, especially if you get older and older and older, and there's that loan on it, and let's say that thing lapses before you pass away, well, not only do you have no insurance and you've invested all that money in it, okay, and maybe you used a lot of that money, or maybe you haven't, you just have stopped paying it, but all those dividends over all those years could become taxable to you. So you want to monitor this thing, and you also want to monitor the loan rate and the dividend rate, like I said, on an annual basis. And if it's inside a trust, that trustee should be going over that with you every year, so you know where that policy's heading. Then there's universal life policies. Back in the 80s, universal life became very popular because interest rates at the time, when Jimmy Carter was in office, were at 19%. So they were giving you a crediting rate based on their reserves or checking account of the insurance company at very high rates. In the 90s, when interest rates started coming down and staying down for long periods of time, those universal life policies, many of them were not funded well enough because people were projecting 8 and 10% on their policy. Big problem. So variable life became very popular because the market got crazy in the 90s. Variable life depends on investments. We can go into this for a long period of time, but unfortunately we're running out of time today. There's index universal life, there's variable life, and there's whole life as some of your permanent policies. And I'd like to get into more detail on some of the differences, but unfortunately we've run out of time today. Hopefully you're enjoying the Main Street Code for Financial Success. Again, if you need to reach out to me, Neil Himmelstein, 631-647-4694, themainstreetcode.com.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.